Now we are going to discuss about the subscribed capital. There can be two type of subscribed. Generally, I am talking here first two type of subscribed capital. Subscribed capital but fully paid. Subscribed capital but not fully paid. And third case will be subscribed capital fully paid and not fully paid. So first we will start with this concept: subscribed capital and but fully paid. When it will happen? See, we know it will be done according to the Schedule 3 of the Companies Act 2013. You have to prepare companies account balance sheet. For companies account balance sheet, this will be the pro forma of that. Equity and liability. Under equity and liability, your shareholder fund will come. Under shareholder fund, share capital, reserve and surplus. There are a lot of other items also which comes under the shareholder fund. Basically, we require these two items while we are doing the shares chapter: share capital and reserve and surplus. And here I have written a column which is known as note of accounts. Here for the share capital I am writing 1, for the reserve and surplus I am writing 2. And it is for the amount for the previous year, it is for the amount for the current year, whatever. If it is 2013-14, according to that we will do it. Generally it will be given on the 1 year basis, so we do not have to bother about the previous year. Here I have wrongly written the previous year, but previous year is not required. Now this will be the pro forma of your balance sheet: equity, shareholder fund, share capital, reserve and surplus. For that against there will be note of accounts 1 and 2. See here I have written a situation in subscribed capital but not fully paid. Here when we can say these things will happen, subscribed capital and not fully paid, when we can say these things? When there will be no CIA and when there will be fully called up value. What does it mean fully called up value? Suppose see here the company has issued 5,000 shares of 100 each. Now the company has decided to call 80 against 100. Remaining 20 will be called for the next year or maybe for future purposes, or not now. They are not calling in this year. So they have not called 20 rupees per share. Against 100 per share he has called up 80. So in that case we will say it is not fully called up value. Here in case of subscribed but fully paid, it will be always fully called up value. If you fully called up value is there, then you will get full payment. If you do not call full amount, you will not get full payment. So in that case we cannot write it is fully paid up, because I am not fully called up. If the amount is not been fully called up, instead of 100 I have called up 80. So obviously the shareholder, the person who is applying for the share, they will pay only up to 80. They will not pay up to 100 because you have called up to 80. So it will not be fully paid up if you call partially. If you call fully, so fully paid up will be happening. Along with that there will be no CI. CI means calls in arrear, means defaulter. If any shareholder becomes a defaulter of not paying any money, or certain portion of the allotment money, as you may be knowing, there are 3 parts: application, allotment, first call, final call. In any of the situation he is not paying the allotment money or final call money. In that case we are going to say it is calls in arrear. You are not going to get that money. In that case then it will not be not fully paid. It will be not fully paid up, not fully paid up. Fully paid up will be happen when there will be no calls in arrear and it is been fully called up. So I have given an example. The company issued 5,000 shares of 100 each. The public has applied for 5,000 shares. Though which I have mentioned, there is no CIA and it is being fully called up. So against 1 I have written 1. Under 1 share capital. Share capital are further being divided. We have talked about few minutes back of previous slide that authorized capital. Here I have not mentioned any authorized capital. Obviously it is nil. If they mention it, you will write it. Put a double dash. and issued capital is 5,000 of 100 each, 5,000 share of 100 double dash. After that, subscribed capital and fully paid. So as I have not mentioned any shareholder is being defaulter, and I have not mentioned that the company has not called full amount, I have not told that anything, the company has fully called up. So fully called up, so fully paid. So 5,000 of 100 is 5,000, 5 lakh. So 5 lakh, this amount will be transferred to the share capital 5,000. So here fully called up value and no CI is happening. Therefore, it is 100 and 5,000 share as the public has applied for 5,000 shares. So they will get the 5,000 shares of 100 each. But in case of a subscribed capital but not fully paid, what are the conditions? Either there can be a CI call scenario or not fully called up value, which is the situation which I have given. The face value per share is 100 and called up is 80, remaining is, so it is not being fully called up, so full payment is not going to, we are not going to get. So if we are not going to get, it should be but not fully paid. Instead of 100, I am going to get 80 rupees. So obviously it will be a situation of not fully paid. So the company has issued 5,000 share of 100 each. Public has applied 3,000 shares. So there may be an under subscription as we have talked previous slide. So doesn't matter, the against 5,000, 3,000 shares the company is getting or the public is applying for that. But the director of the company has decided not to call final call of rupees 20. The final call value is 20, that the director of the company is not bothered to call this 20 per share rupees in this year. So the company is not going to get that 20 rupees per share in this year. So obviously if you are not going to get this 20 out of 120 rupees per share of final call, you are not going to get. Obviously if you are not going to get, so the amount to be paid will not be fully paid. Against 100 rupees you are going to get 80 rupees because 20 rupees are not been called for in this year. So the shareholder will not pay that final call value. So against 100 rupees you will get 80 rupees. So obviously it will not be fully paid. So here what we will write, authorized capital is nil, issued capital is 5 lakh, subscribed capital but not fully paid, as against 100 I am getting 80, therefore we are bound to write not fully paid. It doesn't matter whether it is 2,000 shares or 4,000 shares, doesn't matter, but the amount this which you are multiplying with the number of share is less than with the face value. So if it is less than with the face value, obviously you will get the less money. If it has been 3,000 into 100, we shouldn't have written not fully paid. We should have written fully paid. As it is not happening here, as we are writing 3,000 share of 80 each. So therefore we are not going to get the full amount. So it will come under the banner of subscribed capital not fully paid. So 3,000 equity share of 80 is 2,40,000. In that case, the amount will be, for the second case, if I write this is the case 1 and this is the case 2, for the case 2, share capital will be 2,40,000. For the case 1, it will be 5 lakh, and for the case 2, it will be 2,40,000. So, and I have also written one thing, that the either if it is a CIA or not been fully called up, or both can happen at same time, means CIS also have happened and it is not being fully called up. In that case also it will be subscribed but not fully paid. I will show this case after this slide. So this is the subscribed capital fully paid, subscribed capital not fully paid. As you are required to show these things, then you have to transfer this value to the share capital. This will remain fixed. All the changes will happen in the note of accounts according to the situation, whether it is fully paid up or whether it is not fully paid up.